Iran and the US inked a general agreement comprising of guiding principles to resolve disputes over Tehran's nuclear program. Brent crude cools off on rising hopes for de-escalation of bilateral tensions, lowering supply risks. Oil India and ONGC, as a result of which, under pressure.
Shares of Dilip Bilkon spike in trade. The company emerges as the lowest bidder for a 700 crore EPC project. The order book continues to swell, now nearing the 30,000 crore mark.
Board of Engineers of India is set to mull a second interim dividend for the fiscal on February 26. This follows a strong show in December quarter, stock marginally higher.
Goa bench of the Bombay High Court stays arrest warrant against Ola Electric CEO Bhavish Agarwal, issued by the District Consumer Commission. The stock snaps its 4-day losing streak, but is off the morning highs.
Rally in Paytm continues. Brokerage house Macquarie flags a discount in valuation for Paytm versus PhonePe's proposed valuation in its DRHP. The stock is up nearly 5% in the last 2 trading sessions.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and with me as always is Mangalam Malu. The markets are lower. The problem is the tech index, after seeing a relief rally in the last few days, it's coming for profit-taking yet again. So it's back closer to around the 32,200 odd mark. But the good news, Mangalam, is on top of your head. The green, the Nifty bank as well as the mid-cap index not looking too bad.
Not looking too bad. They're holding up. And the tech index, obviously, after that bounce back yesterday, the question was whether that sustains or not. Turns out there has been some selling. And for the Nifty itself, as we move towards 25,750 thereabouts, there is a fair amount of selling that takes place as well. But we also have with us the management of TVS Supply Chain. And this after the company has gone ahead and written, or done an agreement with an Italy-based company. But we'll get to the management in just a bit. Meanwhile, look at, a couple of these stocks which are moving around. We do have TVS Supply Chain, which was a gainer yesterday, but saw a bit of a drop today, profit booking. Today, we have a lot of these metal names. After underperforming yesterday, they did well today. So we have Hindustan Copper, which is higher by about 4%. Jindal Stainless is the other one, which is up by around 2.5%. We did see, SAIL, all of them coming for some bit of decline yesterday. But now, they perked up, so that's something that we will monitor. And as we do that, let's get you some ideas for for profit coming in from our colleagues at Money Control. Let's go across to our colleagues. Jitendra Gupta joins in with a stock that he's tracking closely.
Coal India is facing near-term pressure as weaker demand and softer realization impacted earnings. But this is temporary. We believe things could improve. During Q3, production remained flat at 200 million tons, down almost 1% on a year-on-year basis. Dispatches also fell by 3% due to lower power demand and high inventory at power plants. On an operating front, EBITDA dropped almost 24% on a year-on-year basis, led by lower realizations and pricing in its e-auction segment. However, now a cyclical recovery is quite possible. E-auction premiums have shown sequential improvement, demand recovery and inventory drawdown at plants could support volumes going ahead. The other key point is GST restructuring. The rate hike from 5% to 18% has corrected the inverted duty structure, enabling utilization of close to 2,634 crore of accumulated input tax credit, which will, of course, strengthen cash flows. Moreover, Coal India is diversifying into rare earth mining and accelerating renewable investments. Overall, some improvement in coal offtake, better realization and benefits of GST and revenue diversification should support overall earnings. Moreover, if you look at stock valuation remain compelling at 7 times its FY28 estimated earning with a dividend yield of close to 7%, offering huge value valuation comfort.
All right, thanks a lot for that, Jitendra. I'll tell you what, slip into a short break, come back. The management of TVS Supply Chain is waiting for us. Stay tuned.
Welcome back. As promised, let's get chatting with the management of TVS Supply Chain. The stock was a buzz in yesterday's session because the company went ahead and wrote an agreement or signed an agreement with an Italian company, Ala Group, to actually enter the Indian aerospace and defense supply chain market. Ravi Vishwanathan, who's the managing director at TVS Supply Chains, joins in now. Obviously, Ravi, we will discuss with you the investment for an outlook from Ala Group under the MOU. We'll also talk about the order pipeline from defense supply and also revision in any sort of growth targets that you have for the next couple of financial years. Ravi, you said that this market in India is $28 billion. That's the overall market. What proportion of this market actually goes into logistics spends? And if you could give us a sense on, how will Ala and you share this revenue and what's the kind of investment that you will make in this deal?
Yeah, good morning and thanks for having us. Yes, it's about a $28 billion industry, and typically supply chain is anywhere between 8 to 12% of the overall size of that market. So we're talking of a significant play here, and this is an evolving area, you want to say, and we want to be pretty early, given the fact that we have very strong strengths in the defense sector. We've been working in the UK and the European defense sector for over 10 years. We have an annual revenue of about 140 million US dollars. So we have a strong play here and the expertise, and coming together with a group like Ala, which is focused on defense, and they themselves are about a $340 million defense player. I think we have a great opportunity in front of us to address this evolving market.
Noted that point, Ravi, and good to see you in as always. Could you quantify the opportunity? What's the total opportunity? How would both of you and the group share revenues? Some percentage share, and what it could mean for the listed entity?
Right. Right now, it is an MOU, and the idea is to look at how we can deepen this over the next coming few quarters to see what kind of structure it can be formed into, given all the regulatory and other compliance. But I think the market itself, we are looking at anywhere in the next few years, even at the tip of the iceberg, it should be upward of about 2,000 plus crores. So it is a very attractive market, given that today India is about 2,500 to 3,000 crores revenue for us as TVS SES. The defense itself would be about that range over the next, I would say, 4 to 5 years. So I think the opportunity is huge in terms of the play. And of course, India is one of the largest spenders in defense, all of us know, and therefore the opportunity.
Right. Ravi, just hold on to that thought. We'll just come to you in a second. NVIDIA has gone ahead and announced a collaboration with a couple of Indian companies. E2E Networks is one of them. Blackwell Group GPU cluster is the other one. And we have L&T and Yota as well. What they'll do is they'll collaborate with these companies for advanced AI factories. We don't know the scope of the revenue. We don't know the scope of the business. We don't know the scope of the order, whether it's come by or not. But AI is the buzzword, right? You name a company, you announce an agreement, you go ahead and there is a stock which has been bid up very sharply.
That's right. I think it's just being announced and these statements are coming in there. But I'll tell you what, I'm looking at some articles, and in the last couple of months itself, they have done some acquisition. E2E Networks, they've acquired 1,000 NVIDIA B200 GPU cluster for the Chennai data center as well. So I think the tie-up, or, they were as doing some business, but reiterating that. And that's why the stock has seen a sharp spike. And I'm not wrong, I think E2E Networks had already seen a sharp correction. So because of that, the street is excited that these comments are coming in there. But, we'll have to see exactly what it means in terms of revenues. But a month and a half ago, there were a couple of newsprints as well that did mention this.
Which explains why in the last 1 month or so itself, the stock is up around 30%. So this is not necessarily new information, but something that the street was sussing out for over a month or so. But let's get back to our conversation with Ravi. Ravi, you did say that the opportunity is large. Yes, 10 to 12% of the $28 billion sort of market. That makes it a near $2 to $3 billion opportunity. But what we want to understand, and because this is an MOU, from a listed company standpoint, how will Ala and you share this revenue? What are the investments that you will have to make? And at the same time, what are the immediate visible orders or the tenders that you are bidding for, just based on the announcement that you made yesterday?
Right. So, like I said, this is an evolving space. For us, we will work on it. The reason why it's an MOU is because we will look at it from an opportunity to opportunity perspective. We are looking at opportunities both in India and in the Middle East. So we are looking at how we can work together. And the way we work is really, there is a sourcing, there's a procurement, there is a systems integration, and there is a distribution, right? So this is the chain in which we will operate. In India, we think that we will have a very significant play in the sourcing, procurement, and distribution space. And we will lean on the expertise, especially on the aerospace side, from the domain side with ALA. So there is no specific revenue sharing agreements. It will be based on each of these engagements, each of these solutions. I would expect that TVS SCS will have a majority share of revenue when it comes to working in India, and we will evaluate the opportunity, especially in the Middle East, depending on the level of joint engagement that we would have. But for us, clearly, India is the market. India is a place where we believe that there is a significant opportunity, and the recent signing of the Rafale only further strengthens our belief that this is an opportunity in the aerospace and defense that we should capitalize, given the experience that we have. So, specifically to your question, we will probably have a majority share in the India business. As far as investments are concerned, it depends really on the solution. What kind of structure, what kind of facilities we need to have, what kind of transportation and distribution mechanisms that we need to build. And each of these are solutions that we will create based on the requirement from the tenders and so on. So I would say these are early days, but clearly we have a first advantage given the experience and the strength of having worked on similar engagements outside of India and bringing that know-how from UK and Europe into India, which we have been focusing on as an organization across the globe.
Okay, all right, Ravi. Final question. This be a margin accretive business? I'm looking at a business assets. You're doing around 7.5% to around 8% of margins. Will this be actually better margins?
I would say, given our portfolio today, the defense definitely has a better margin profile than the rest of the business. We expect that to continue, and that is the whole focus of the company is converging towards that 4% PBT. So anything that we do is if we're looking at margin accretive businesses that we want to engage in, so that we can get convergence on that 4% PBT quicker than our original plan.
All right, take that point, Ravi. Thanks a lot for joining in and explaining to us that still in early stages, still evaluating projects, still evaluating the immediate revenue accretion that would happen to you. But for now, it is a step in the right direction and there is a business opportunity out there. The street will attune itself to those comments that you've just made. We take a short break, come back on the other side. The management of Wakefit Innovations joins us to discuss their business outlook after their third quarter numbers. Welcome back. Let's get chatting with the management of Wakefit. Wakefit, the stock is up 17% this month. In fact, from its post-listing low, it's recovered about 30% and now above its issue price of 195 rupees. Chaitanya Ramlingegowda, who's the co-founder and executive director, joins in. We'll obviously be discussing their third quarter numbers, but more importantly, the outlook for the fourth quarter and the year ahead as well. Thanks a lot, Chaitanya, for joining in. First 9 months, your revenues are up 18%. When you joined us during the IPO, you said that 20% plus is a given in terms of revenue growth. So the fourth quarter, are you on track for 20% plus revenue growth this entire year? And will that continue into FY27 as well?
In the furniture sector, we are consistently growing about 24-25% in the mid-20s actually. But in mattresses, there has been a little bit of a competitive intensity with younger brands raising funds and trying to be innovative on the online market. So there we will have to drive up our marketing spends. So that is the reason the guidance also was that we will come back to historical averages of 8-9% of net revenue as marketing spends. But yeah, we think that at a company level, aspiring for a number that's close to 20% is the right ballpark.
Okay, all right. Hi, Chaitanya. Good to see you, Ben. Well, in line with what you had guided for, the margins have been improving. How much more headroom do you have on that front? And what should the broad range we should be working with?
So when you say margins, I'm guessing you're referring to the Ind AS operating EBITDA.
Right.
So in terms of that, we consistently see that there is headroom for improvement over the next 6 quarters, and most of the juice coming from the furniture category, which is relatively new and where the greenfield project has a lot more capacity to be utilized. So as the demand is going up, both the utilization of the machinery as well as utilization of the warehouses in our middle mile and last mile across the country that we have set up, they go up, and that enables us to drive more margins. So we believe that in furniture, there could be at least 4 to 5% of margin improvement to the company possible over the next 6 to 8 quarters.
You don't give specific EBITDA margins and the revenue performance of the furniture segment and the mattress segment. Can you tell us where they stand at right now for both mattresses and furniture when it comes to margin contribution?
Yeah, we don't do segment level EBITDA primarily because it's very hard to segregate the costs below contribution margin, because it's the same people across the central teams working across the same three categories of mattress, furniture, and furnishing decor. But if you look at the overall contribution margin level, mattress is the most profitable, followed by decor and living, followed by furniture, given their age. It's exactly in the decreasing order of their age. Mattress is the most mature, so the most profitable, contributing more to the company. Accessories, which is furnishing, decor, they're the second oldest. They've been around for 7 years or so. And furniture is barely 3.5, 4 years or old. So they are still on that journey of contributing more. But all of them are largely close to, all of them are above break even from a margin perspective.
Okay, all right. If I look at a store addition and compare it with last year, I think the addition is close to around 30%. So is SSG negative for this year?
No, triple SG is actually more than 20% as we speak. It's that if you remember, the way we look at the business is own channel versus external channel. And own channel comprises of our D2C website and our company-owned, company-operated EBO stores. So the revenue moves between these two channels internally. But what we worry about is own channel number, which is currently about 2/3 of our overall revenue. Nearly 65% of our revenue comes from these two put together, and only 35% comes from external channels where we don't have much control. So store EBITDA, store SS, triple SG, all of them are trending fairly healthy, but customers may transact on D2C or EBO depending on their frame of reference.
And how is your revenue mix likely to evolve from here in favor of furniture? Currently, it's about, 29% coming in from furniture. Where does that go?
Over the next 3 to 4 years, we feel that it will come close to mattress because furniture is growing in mid-20s and mattress is growing in mid-teens. So over the next 3 to 4 years, we feel that it's going to catch up to mattress in terms of revenue.
Okay, all right. Final question from my end before we let you go. In the coming year, profit number, the net profit number comes in at around 100 crores. Is that possible?
We are aspiring to, but last quarter,
Can it be more than that, sir?
No, I think we are a company that always thinks a little long term. So if we worry about stock price and don't take the right call for the company, it come back to bite us later. So we want to make the right investments in people, right investments in marketing. So we don't want to squeeze out every rupee just for the sake of that.
Got that. We'll let you go on the PAT number, but at least revenue growth aspiration, what it could be for FY27, going by what you're saying, what can a margin band look like? And ultimately, we'll derive the PAT number.
So you somehow want to get the number. But yeah.
If you can give it to us, why not, right?
Yeah, for FY27, at least we still foresee that the company can continue to deliver late teens kind of a growth number. Margin expansion, though, although a lot of the margin will come up, will we let it accrue or will we reinvest back into the business? We will only have clarity once the annual operating plan is approved by the board. So maybe next quarter, I'll be able to give you more details.
All right. We will press you once again next quarter and ask you for better clarity on what you're going to do with that margin expansion. At what level will that be capped? Because during the IPO, you said that you will leverage some of these ad spends, but now the unforeseen competitive intensity has come back from some of the new age players who've raised funds. So how does that impact your business in the mattress space is something that we'll be tracking going forward. Thank you, Chaitanya, for joining in. Good luck. With that, we will take a short break on Chartbusters wrap up on this edition. And stay tuned. The team of Trading are up next.